Good evening.
Good evening.
The last time we met, we were going through how to manage account receivable. Okay, and I think we did one question from the mock paper. Okay, so we agreed again to one more question, and then I guess we can discuss on appraisal of investment. Okay. Any question we'll be having regarding how to manage account receivable? Any possible question that maybe we may have not done together? Look, this is your revision, so if you want to give the question, it will be good for us. Any question we having that we can do? No question. Okay. That's a good sign, I guess. I'm sure I can get one. So they can get one good question on account receivable management. Seems like we have done most of the question together. Okay. So you can do one where there's factoring. Let me look for a question where we have factoring. That would be, I'm not sure they've shared this question with you, but give me a minute to share. Let's do it together. Okay, so that's on the area of factoring. So being asked here to determine which option between option 2 and option 1 that the company should take. Okay, so let's begin with option 1. Okay, in option 1, the company want to take a factor, okay, in invoice and sale accounting and receivable collection on a full recourse basis. Okay, don't forget what we mentioned regarding whether to use recourse or the case of without recourse and with recourse. Don't get in the case of with recourse, okay, like in option 1, then the company continue bearing its own bad debt. Okay. The factor would charge a fee of 0.5% of the company credit sales per year. So again, you can begin there by getting the fee. Okay, so option 1, factor fee, the fee you pay to the company that will be managing your account receivable, 0.5% of the sales you make on credit. Okay, the sale the company makes on credit, you'll be told the company has a revenue of 28 million. Okay. And all sales are on that day credit. Therefore, we multiply by 28 million. Therefore, how much fee, therefore, do the company pay to the factor for managing their account receivable? What do you get? What do you get?
140,000.
140,000. Okay. Get 140,000. Therefore, with the fee the company pays to the factor. Okay. Then we do that. The company is that this is going to lead to a saving in admin cost of 1,000 per year. Okay. Under this arrangement, the average days would be 30 days. Okay, there is no mention regarding the company bad debt expense. We assume they remain as they were. Okay, so there's no saving the company makes towards the decrease in the bad debt as per option 1. Okay, however, there's a decrease in the number of days to 30. So currently, the company investment, so here it's receivable investment. Okay, current investment, you've been told is equal to 5.37 million. Okay, if the company implements the proposal, the number of days will decrease to 30, will be 30 out of the number of days in an year, 365. We multiply by the account, by the sales made on credit. There's no mention regarding the increase or decrease in sale because we assume they remain at 28 million. Therefore, what's the of the company investment in account receivable? Can you get how much?
$2 million.
2 million.
301,000.
301,000.
369.8.
Okay, so 370. So therefore, this to therefore 370. So since therefore there's a decrease in the investment from 5.37 to 2.3 million. That implies therefore there's a decrease. Therefore, the company will be saving. Therefore, interest cost saving. The current financial year, they charge the company a fee of 7% per year. They will save 7% times the decrease from 5.37 million minus 2.3 million, 370. So since the company investment in the account receivable is decreasing, that implies that for you save interest, okay? Because you used to finance working capital to the extent of 5.37 million before. After you finance only 2.3 million. There was a decrease in the amount you'll be saving, a decrease in the interest you'll be paying to the financier. What was the decrease? You get how much?
$214,000.
214,000.
804.1.
804. Okay, get the fourth. The amount of saving, the interest cost saving the whole company at 14,804. Okay, that is definitely a benefit to the company. Okay, and I think that is it regarding option 1. Okay, therefore the net saving or the net cost of the company therefore will be equal to can be interest cost saving. Interest cost saving, which is equal to $214,804 there's a decrease in admin costs by 30,000. Admin cost saving is equal to 30,000 per year. And that is it. Then we less the fee, factor fee. The company is paying the factor for the management of its receivable to a fee of 140,000 to the tune of 140,000. Therefore, net saving the company, if they were to use the factoring arrangement, therefore we go to 104,804. 114. Yes, 114. 114. Confirm.
It's 104, not 114.
How is it 114? 214 plus 30, that is 254 minus 140. Is this okay?
No, it's 104.
It's 104. Is it 204 or 214?
It's right. It's 214. So 214 plus 30 will be 244.
244 is 244. I see. Thank you. Okay, therefore we get 104,000. That will be therefore the net saving if the company was to use option 1. Okay. Option 2, if the company takes option 2, therefore, we've been told this is going to be a non-recourse basis. That means therefore the factor that the company managing the account receivable pays the company bad debt. Therefore, the company, all the bad debt expense, therefore becomes a saving in the company. Okay. Then we can begin here. Bad debt. Okay. Expense. Now they become therefore saving the company. Okay. Previously, they were equal to 2% of the sales on credit. 2% of the sales on credit, 24 million. Okay. To give us 560. Okay. This was the company bad debt expense of 560. If the company was to use the factor, therefore the bad debt expense will be 0. Therefore, they'd save the entire 560. Okay. Next, in between that there'll be a fee of 1.5%. Okay, factor fee. To use the service of the factor, we pay a fee of 1.5% of the sales on credit, which is equal to 28 million. To give it therefore 420, I guess, not so sure.
Yes.
Okay, therefore, we pay a factor fee of 420,000. Okay. Then we do that. This is going to the factor will be requiring the company to accept an 80% advance. Therefore, the amount to be advanced is therefore 80% of the revised credit sales. The revised credit sales, okay, doesn't change. The number of days remain as they were. Okay. Since the number of days remain as they were, that days, therefore the investment in account receivable is equal to 2.3 million. We don't need to work it again because we've already done that already. That implies therefore the company, the factor will be advancing 80% of this revised account receivable. Therefore times 2.301 370. Therefore, how much money will be advanced to the company? 1 million.
814,096.
814,096. Okay, that's the amount that will be advanced to the company by the factor. Don't be
841, sorry.
Sorry?
841.
Or 841, not 14. 841. 841. Okay. Don't forget or be careful regarding the amount to be advanced. The amount to be advanced is based on the account receivable. Okay. Even though the examiner might tell you that the amount to be advanced is based on credit sale, but don't forget the account receivable is the average sales made on credit. Okay. Don't forget that. Okay. Therefore, since we have done the advance, therefore the amount to be advanced, the advance fee, the incremental amount that is paid the company. Don't forget the factor will be paying the fee to the company. The fee, the factor will be charging the company for the advance is 9%. Okay, but don't forget, even before the factor came over, the company was being financed by the bank through overdraft at a cost of 7%. Therefore, the incremental cost is equal to 2%. Okay, the factor is going to be charging 9%. However, don't forget, before the factor came over, the company was being financed by a bank at a cost of 7%. Therefore, the incremental cost, therefore, is the 2% times the amount advanced, 841,096. To give us how much?
$36,822.
That's 6,822. Therefore, the incremental amount the company paid because of the amount they've been advanced by the factor. Okay. And that is it, I guess. Anything else remaining? Okay, so since the number of days, okay, see, admin cost will be the same, that 1,000. The number of days will be the same, they'll be decreasing to 30. That implies, therefore, the interest cost saving also remain the same at 214,804. So we don't need to work it out again, therefore, solution may be equal to, we can begin the savings, can be in savings here, there was bad debt decrease. As I say, the entire budget become a saving to the company, which is equal to 560,000. Okay. Then what else we have? We have interest cost saving, which remains as it was at option 1. So which was 214,804. 214,804. Admin cost saving is all the same as option 1. 30,000. But anything else? That is it. Therefore, we less factor fee. The factor fee you're paying is equal to 420,000. Okay, we also pay in here the incremental amount paid because of the advance. Okay, there's advance fee in quote, that's 6,822. And that is it. Net saving.
$347,982.
47.
347.
It's 47,982. Okay. Therefore, don't forget the both method. If you take option 1, you have a saving, which we got as 104. Okay. Also, we have 347 in case you take option 2. However, we need to advise the company which option is better. Definitely, the company, okay, should take option 1. Okay, should take option 2. Sorry, option 2, since it has a higher annual net saving. Okay, of 347,982. Don't forget to always give the advice. Okay, don't forget to always give the advice to the farm. Okay, and that's all. The account is suitable. Okay. Any question on account is suitable? On this question? Okay, no question. Okay, that's next, cash management. And towards the cash management, we say that the idea here, we want to get to understand is we don't want to have a case where the company has an excessive cash at hand, okay? Neither should we be having too low amount of cash at hand to an extent that we do face chances of illiquidity, okay? So we want to ensure that we strike a balance, the same way we did in the case of inventory. We don't have a case of cash deficiency. Neither do we want to have a case of having excess cash than what we need. Okay, so under cash management, we want to establish therefore what is the right amount of money we ought to be having or trading. Okay, and you see that you can use two models. Okay, you can use two models to help us in determining the optimal cash balances. Okay, we have the first called the Baumer model. Okay, and you have the Miller-Orr model. So the two models can use that can help us in cash management, Baumer model and the Miller-Orr model. Okay, so this is simply a readaptation. This is simply called a readaptation of the EOQ model, the one that we use under inventory management. Okay, the EOQ model. So we're going to see, is it possible for us to try to coin, okay, the EOQ model to be suitable for cash? Okay, and you see that the Q, okay, proposed by the Baumer model is equal to the square root of 2 annual demand of cash, okay, or annual surplus cash in case you have surplus. Okay, we to multiply by the transfer cost, okay, the cost per transfer, we divide by the holding cost of cash. Okay, so here the transfer cost, okay, is every time that you make an investment. So here we are making an assumption that if the company has, this is not P, I hope it doesn't appear as a P, this is a D, this is annual demand. So the cost, we are making an assumption that, hey, if as a company you have excess cash, what do? You need to invest that cash in the market of securities. Okay, you need to invest that cash in money market instrument or the marketable security, the money market instrument. Okay, and since you're going to be investing, for example, through a broker, they do require to be paid. You have to pay them. Okay, so the fee you pay for the investment you make to through the brokers is called the cost of the transaction. Okay. Also, in case you're making a disposal, in case you have cash deficiency and you want to boost your cash balance, what do? You're going to be informing, you give an instruction, okay, to your broker, hey, dispose of some of my previous money market instrument investment which I've made already. Okay, therefore the cost we can, don't forget they're going to be working for you. But the implying therefore they charge you a fee. Now the fee you pay for to the brokers for working for selling or buying security on your behalf is what we call the cost of the transaction. Okay. Now, don't forget, this is the holding cost of cash, which is the interest. Okay, so in case you don't invest cash, what do? You'll be losing any potential interest you could have earned. Okay, therefore that's the Q proposed by the Baumer model. That if the Q, for example, is let's say $10,000, in case as a company you're having cash surplus, what does it mean? It means therefore every time you make an investment with a broker, you'll be investing instrument worth $10,000. Okay, don't invest $9,000. Don't invest $11,000. Invest $10,000. Okay, if you have cash deficiency, therefore what do? You would be disposing of securities worth $10,000. Okay, even if your need is $2,000. Okay, because of you want to reduce the number of transactions. Okay, you'll be selling off money market instruments worth $10,000. Okay. And that's on the Baumer model. Okay, let's say that the total cost of cash, okay, total cost of cash, okay, therefore, of course, the holding cost, that is interest foregone, plus, okay, the transaction cost, okay, holding cost of cash, of course, definitely is the interest you could have earned, okay, the Q you have at hand, okay, times, this is the Q, we divide by interest, so this is the Q divided by 2. Okay, to get there for the average amount of cash you have at a point in time, we multiply by the interest it could have earned for you, okay, the holding cost of cash, plus the number of orders per year, the number of transactions per year is the annual demand of cash, okay, we divide by Q, we multiply by the cost per transaction, okay. Give us therefore the total annual cost of holding cash, okay, total cost of cash, the holding cost plus the transaction cost. And that's on the Baumer model. Question? Now, the same assumption that for the case of the EOQ model, are also the assumption we have in the case of the Baumer model. Question? No question? Great. Next model is the use of the Miller-Orr model. And this model says that one of the key drawbacks of the Baumer model was that we are assuming that the company, the company cash balances to be fluctuating through a predetermined fashion, which is not the case. Okay, In reality, the cash balances will be what referred to as they be meandering up and down. Okay, there's no any predetermined fashion upon which the cash can go. It can go up and down. Okay, some point there can be a huge increase, other point decrease. Okay, the decrease in the rate of decrease, it can be increasing, decreasing. So there's no way that a company can have. We can assume that in reality, cash is going to be increasing or decreasing at a constant rate. That's not going to be the case. The reality that the cash will be increasing, decreasing, and a decreasing and a decreasing rate altogether. Okay. Therefore, the cash balances, as per the model, what we want to establish here is what we refer to as limits. Okay, what we establish for the limits. Okay, well, the company should need to know. Okay, what is therefore the maximum cash, for example, you ought to be having. Okay, we establish therefore the what we call the upper limit. Okay. At the same time, we want to establish what should be there for the lower limit. Okay, we don't want to have a cash to be too high. Okay, neither should you want to have a cash balance to go below a certain point. It is true the cash should be moving up and down. Okay, that's true. That's the reality. However, we want to ensure that if they don't go beyond a certain point, neither do they go below a certain point. Okay. Of course, if it is a company, you have what called you have the aim. Okay, where do you aim your cash to be at? Okay, what is the optimal amount of cash you want to have? Okay, what referred to as the return point. Okay. So as I mentioned, the reality regarding the movement of cash balances is that the cash balance is moving, okay, they're moving up and down. Okay. Then in case the cash balance is too high, if we have too much cash, that is, we don't want it to move above the upper limit. So in case the cash is approaching the upper limit, what do? You decrease it back to the return point. And how do you decrease it? Okay, by buying security. You need to buy securities. Okay, if the cash moves towards the lower limit, okay. Okay, if the cash moves towards lower limit, for example, what do? You need to boost your cash back to the return point. You want to ensure that it doesn't go below the lower limit. What do? You increase the cash balance back to the return point by or through the sale of the previous money market instrument which you have bought. Okay, so here you need to increase the cash balances through the sale of money market instrument or marketable securities. Okay, you want to boost cash back to the return point. The question is, how therefore do you establish these limits? How do you know the upper limit, okay, return point, lower limit, okay? The lower limit, it's you as management to set, okay? Lower limit, it's you as management to set your lower limit, okay? The minimum cash balance you want to have at point in time. The return point, the difference between the upper limit and the lower limit, okay? It is what we call the spread. What implies therefore the upper limit is equal to the lower limit. When we have said that the manager has the one to be setting it, plus the spread. The return point, which is more or less like the optimal cash balance, is equal to the lower limit, plus that of spread. Okay, and yes, and the spread is equal to 3 over 4 cost per transaction, CT, the cost per transaction, we multiply by the variance of cash flow, variance of cash, we divide by the interest to the power of a cube root, and you get the cube root, and therefore give the spread. Okay. So here's the cash balances. Okay, approaches the upper limit. You need to reduce the cash back to the return point. Okay, as you have seen here. Okay. They'll see at this point in time. Okay, reduce it by buying money market securities. What's the difference between the upper limit and the return point? If the cash balance approaches the lower limit, we need to increase the cash balance back to the return point. By doing what? By the selling of securities, what's the difference between the return point and the lower limit? Question? Okay, no question. The next tool we can use when it comes to cash management is the use of the cash budget or the cash forecast. Okay, so you can use also the cash flow forecast and cash budgeting. In cash budgeting, don't forget, all you need is to quantify all the cash inflows for the company. You quantify all the cash inflows, okay, be revenue, okay, revenue from a revenue source or from a capital source, okay. You're going to be quantifying all the cash, okay, be they from revenue or from a capital source. Revenue means that these are from the day-to-day operation, okay, sale of the company good, okay, Okay, so the normal company day-to-day business, okay, is what referred to as the amount received from the revenue source. From capital source, there's again be money received from a long-term finance source. Okay, this is again from a company long-term finance source, either from sale of an asset, okay, sale of company long-term assets, okay, from loans, okay, received from grants in case of any grants, okay, from issue of shares, okay. So we don't make a distinction where the money comes from, whether it's from a revenue source or from a capital source. Okay, provided the money is into the business. Okay, and of course the same applies in case we quantify the cash outflows. We don't make a distinction where the money is coming. Are the consumer? Are they revenue or are they capital in nature? Okay, we don't make a distinction. Okay, when preparing the budget, okay, of course the budget will be as follows. Okay, a very simple way of trying to prepare the budget. Okay, we have all the cash inflow, for example, month of first month, second month, third month. Okay, you have here all the cash inflows. Okay, the first one, second one. Okay, total cash inflow, for example. Okay, for the 2 months, then we quantify all the cash outflows. Okay, for example, salaries to the employee, payment of loan interest. Okay, dividend the company has paid, purchase of motor vehicle. So all the different cash transactions that occurred in the year, purchase of motor vehicle. So you quantify them. Okay, so these are cash outflows. Okay. So here we have, therefore, we do the net, that is the cash inflows minus the outflow. Okay, we get therefore the net cash inflow, the net cash flow for the month. Okay, for the first month, second month, third month. Okay, then of course we bring forth the cash balance at the beginning of the month, cash balance brought forward. Okay, and have therefore cash balance carried down. Okay, this will come therefore the opening balance for the next month. Okay, this will come the opening balance for the next month. That simply is how you prepare therefore the cash budget. Okay, don't forget the key thing you have to note is that we use the cash basis, not the accruals basis. Okay, that is what you can make mistake in. Okay, we use the cash basis, not the accruals basis, when preparing this cash flow forecast of cash budget. Question? Question? If no question, it means that that was an easy area for you guys. I'm not sure if you've done May 2018. Have we done May 2018 question 1C? May 2018 question 1C. Have you done it?
Yes, we have.
Okay, great. Okay, since we've done that, then that was on the Miller or model. I'm not sure we can get one from Blamor model. If we can get one. If we can get one. Are we done? And this is question November 2017, question 5D. Have we done it? This is on the Baumer model. November 2017, question 5D. Have we done it?
Yes.
Okay, great. Okay, and I think if you've done that, I guess that's the end of that area then. Okay, I guess if you've done that, then, and as well as you've prepared a cash flow forecast together. Any question before I move to the next area?
Excuse me, sir.
Yes.
For the sake of the people who weren't there in your previous class,
Yes,
is there a way that we could do the question maybe in a quick way? in order to save time also, but cover the question.
Yes, because now the problem is that, thank you for your suggestion. However, for the sake of then I guess maybe the best thing you can check is ask them to give you a solution to ask this question. Because I don't want to do a question which I think most of us have already done. So in case it's a question which you have and which okay, if you have a question, the best thing could be in case you have a question, okay, you bring it forth, okay, because I don't want to leave a question which you already done. That's the idea. For the sake of knowledge, but in case you have a question, you bring it forth. Okay, that's. I would want definitely do that. Don't forget you only have today. Don't forget you only have today to cover the entire syllabus. So in case you have a question that you want us to cover, then you bring it forth. What of December 2014? This one I think I know with the 10th, December 2014. So in case a question which I not cover, okay, which the others have done in class, then just get a contact from one of you, and then they can share with you how we did that question. Because for sure I will not repeat a question which we have done together. So December 2014 question 5C. So I don't know who it was, but take note of the those who are in class. Then after class, in case you can try to follow up with them, they can give you the solution to some of these questions. Have we done this December 2014 question 5C? Have we done it?
I don't think we did that one.
Okay, great. And I'll share the question with you right now. So go through it, we discuss together. Okay, go through it. I'll send on our WhatsApp group. Okay. Suppose you're going through the question. So being asked here they get the return point, average cash balance, and the upper cash limit. Okay. So the first thing, of course, is to get the spread. Okay. The first thing is to get the spread, which will be equal to 3 over 4 times the cost of transaction, the cost per transaction, 200. You multiply it by the variance of cash flow. You've been given standard deviation, so you need to convert standard deviation to variance by squaring it. So 800,000, okay, squared. You need to use the variance. We divide by the interest per. Don't forget you have to what is the term, okay, or what is the period of assessing the standard deviation? It's daily, okay. As you can see, this is daily standard deviation, okay. Would imply that the interest must also be daily, okay. The interest must also be daily. The term must be the same. The period must be the same. Therefore, 12% is per annum, okay. Therefore, per day we divide by 365, and we get therefore we get the cube root, okay, the power of a third. And then we'll get 4, give us the spread. Once we get the spread, then we shall get the others. So get the spread first. What was the spread? You just feed these figures to your calculator. It should not take that long, for sure. Robert, that answer is too high. I doubt it. I don't know, but it's that one is too high. Check again.
Okay.
Okay, I'm waiting for the spread.
Um, 1,990,990, 286.
Yeah, that sounds a bit close. I think someone confirm that. That sounds a bit close. Someone confirm that.
I got the same.
Sorry, you got what? What did you get?
1,990,286.
I'm losing a bit. I don't know whether it's the internet or what.
I got 1,990,286.
Okay, the same. Okay, great. Okay, so I suppose that's the spread. Okay, so if there's a spread, okay, and I suppose all of you have that, okay, then therefore the return point. Don't forget, all you need just feed in this in your calculator. Nothing else. There's no strange thing happening here. Just feed this in your calculator. Don't forget, in case you want to power, the power should be in brackets. Maybe that's why you can make mistake. And of course, you multiply after you've done this part first. You give multiply by 3 after you've done this part first. Okay, the return point we said is given us the lower limit, okay, which is equal to 1.5 million plus the spread, okay, plus a third of spread, plus a third of the spread, 1,990,286. We get how much?
2163.
2163.
428.7.
429. Okay. Because the turn point, that's where the company aims its cash to be at, okay, which is equal to 2,003,429. The next we meant to get let's first get the upper limit. The upper limit, this is given us the lower limit 1.5 million plus the spread, which is 1,990,286. Give us 3,490,286. I'm not sure. Confirm the upper limit.
It's correct.
Average cash balance. Thank you. Average cash balance. I gave a formula. I can't remember the formula I gave to you. What the formula I gave to you? Those who are in class. Well, I think I gave a formula for average cash balance, which I think I don't have with me. 4 times.
4 times return point
Minus.
minus lower limit over 3.
We divide by 3. Thank you. Therefore, together with cash balance, therefore, will be 4 times the return point. Okay, minus lower limit. We divide by 3. 4, the return point we got was equal to 2,163. Okay, 429. Lower limit is equal to 1.5 million, and we divide by 3. Okay, 4 times the lower limit minus 4 times the return point minus the lower limit, we divide by 3. And we get how much? $2 million.
$2,384,572.
384,000. 572. Okay. That's therefore we use the mill or model. Okay, we use the mill or model. Okay. Any question? Okay, that's on cash management. Okay, don't forget the way I've said regarding how to prepare the cash forecast. Okay, quantifying on the cash inflow and the cash outflow. Okay, you need to quantify and you prepare it based on the cash basis. You prepare it based on the cash basis. Lastly, okay, it's on the financing and working capital. When it comes to financing and working capital, okay, you see that you can use two strategies. Rather, you can finance using three strategies. Okay, you can finance using aggressive financing policy. You can finance using the conservative financing policy. You can finance using the margin, okay, of financing policy. For the aggressive, you see that you give me financing using the most risky financing alternative. In this case, be finance using it short term. So therefore, the company working capital need are finance using short-term finance sources. In the case of the conservative, you again be using the one that is a bit less risky. Therefore, financing using long-term finance source, okay, or long-term loans. Okay, margin policy, you'll be financing the company current fluctuating. You'll be financing the company fluctuating current assets. The fluctuating current assets, okay, using the short term, okay, and the company permanent current assets. The company permanent current assets will be financed using the long-term financials. Okay, that's what's regarding how we finance the company working capital financing policy, aggressive, conservative, and the margin policy. Don't forget the short-term financials is more risky. Okay, it's more risky, but okay, it's cheaper. Okay, this one is less risky. The long term, okay, is less risky, but more expensive. Okay, so that's on working capital financing policies. Okay, working capital financing policy. And we went ahead and prepared maybe the distinction between the fluctuating and the permanent current assets. Okay, we prepared a table, okay, to make that distinction between the fluctuating and the permanent current assets. Okay, so I don't know if you can have a question. We can do it quickly. A question, of course, once we have not done. They don't come that often. A question regarding how to make a distinction between the seasonal and the permanent current assets. Okay, and if you don't get one, then you go to the next area. Okay, and I can say question. Anyway, just to give an example on how to make that distinction between the fluctuating and the permanent. Okay, if for example you have the period being week. Okay, we have week. Okay, so we analyze. Okay, on the first day. Okay, what's the company working capital investment? Okay, assume that the company working capital investment in day one is 10,000. Okay, day two is 20,000, and day three 18,000. Okay, day four 12,000. And day five 8,000. Okay, don't forget to say the permanent current asset is the minimum within that. Is the minimum investment within that time period. In this case, 8,000. Therefore, the permanent current assets for the company is 8,000 throughout, but because that is the minimum for that time period. Any extra over that minimum is what called the fluctuating current assets. Okay, in the month, in the day one, we have the extra being 2,000. The extra being 12,000, okay, the extra here being 10,000, the extra over and above the minimum 4,000, and the final day 0. Okay, as we are saying, if you're going business aggressive, you finance the company total working capital. Okay, using the long term. Okay, you're using short term. Okay, if you're using the conservative policy, you finance the company working capital need. Okay, as it is here. Okay, using the long term. If you use the margin policy, you finance the permanent using long term, and you finance the fluctuating using the seasonal, or using the short term finance source. Okay, and that's on working capital. Any question on working capital? Don't forget, there'll be a question most likely. from working capital. Okay, in your exam, either inventory, receivable, cash management, that will be a question most likely. Okay, in your exam regarding how to manage working capital. Any question before we move on to the topic? No question. Then next topic, okay, is on investment appraisal. Okay, next topic is on investment appraisal. Another area that, of course, the examiner will have to test you. So that when it comes to investor appraisal, okay, what we want to determine is that we want to determine, okay, where should the company invest its money in, or rather, how much value are we going? Will the company be receiving if that invest in a given product, in a given there's a project, for example, okay. And so that you can use the appraisal method. You can use. You can classify them into many categories. We have the non-discounted cash flow technique. It's called cash flow techniques, okay, or methods. And you have the discounted cash flow techniques. The key distinction is that here, in the case of the non-discounted, we don't discount the cash flows. In the case of discounted, of course, therefore, we get the present value of the cash flows. In the case of non-discounted, we say we can use two methods. We have the use of the payback period method. Is a payback period method. In the case of, we can also use the accounting rate of return, the accounting rate of return. Okay, also referred to as the return on capital employed, return on capital, okay, employed. In the case of discounted, you can use three methods. You can use the NPV, the net present value method. We can use the IRR, the internal rate of return, and you can use the discounted payback. So those are the five methods you can use when it comes to the appraisal of the investment. Okay, those are the five methods you can use when it comes to the appraisal of investment. Payback period. Okay, you have to give me the first method, the payback period. Is how long does it take the company from the time that you invest your money in the project? How long does it take for you to get back that enough that cash? Okay, you did invest 1 million. How long do you take to get back that 1 million? The payback period. The account of return, the account of return. Okay, the ARR. Okay, is giving us the average investment. Average profit, sorry, average profit, okay, we divide by average investment, because we express as a percent, okay, that's on the ARR, okay, average investment, average profit, we divide by average investment, where average profit is simply average profit is equal to total profit received over the life of the project, the entire project life, we divide the number of years, okay, average investment is equal to the initial cost of the project plus the scrap value. Okay, we divide by 2. Okay, therefore the average investment. Okay, that's on the ARR. Okay, on the payback, just to go back to the payback, how do you know whether you're going to invest or not? We compare with the target. Okay, the company will be having what we call the target payback period. Okay, so if the target is, let's say, 10 years, not 10 years. If the target is, let's say, 3 years, there's a target 3 years. The target payback period, and this investment pays in 3.5 years, then we reject it. Why? Because it's paying beyond what was the target. The target is that they must pay within 3 years. So in case it pays in 3.5 years, then you reject. Okay. Towards the ARR, same thing. We determine what was the target. The company will be having a target return on capital employed. If the target is, let's say, if the target return on capital employed is equal to, let's say, 20%, and the investment has an ARR, okay, or return on capital employed of, let's say, 25%, then we accept. Why? Because the ARR of the investment, 25%, is greater than the target of 20%. Okay, that's on the use of the non-discounted cash flow techniques. In the case of the use of discount cash flow techniques, the use of discount cash flow techniques, you say that the first thing we need to discount the cash flows back to year zero. Okay, so we need to get the cash flows in present value terms. You get the present value cash flow in all these methods here. At the NPV, in the case of the NPV, so the NPV is giving us the sum of present value of the cash flow to be earned over the entire life of the project minus the initial investment cost. Ensure that for the NPV is the excess of the initial cost over the sum of present value of cash flow to be earned. Okay, so if you do invest 10 million, okay, and you earn 13 million, okay, therefore the excess 3 million. And if we're going to be having a positive, okay, like in this case here, then you accept, because you're going to be getting more money, 13 million, than what you spent 10 million here. So if you have a positive NPV, then of course you accept. If you are negative, you reject. Okay. Towards IRR, okay, so this is the discount rate that we use, okay, that will give us an NPV equal to 0. Okay, this is the discount rate that once we discount the cash flows using that rate, we get an NPV equal to 0. Therefore, we compare this with the financials. What return do they want? Okay, what we call the cost of capital. So if the cost of capital, for example, is equal to, let's say, 13%, and the IRR, not A, but IRR of the project is, let's say, 10%, then of course we reject. Why? Because the IRR is rate of return. Therefore, the rate of return here is 10%, the cost is 13%. Then of course you reject, therefore. Okay, if the IRR is lower than the cost of capital. If it is higher, let's say at 15%, then of course you accept. Why? Because the return to be received from the project, the main return is 15%, and the cost of capital is 13%. Therefore, this is a good investment. Therefore, okay, it becomes therefore should accept this particular project. Okay. Now, towards the payback period, okay, the use of discounted payback period, it's simply how long do you take as a company to get back your money based on the present value of those cash flows. Okay. As the use of the discount. This just like the payback. The only difference is that now these cash flows have been discounted. Okay, back to year zero. Clear? These are the 5 appraisal methods that we use. Any question? Don't forget.
I have a question.
Yes, Kemunto.
On the ARR.
On the
ARR.
Yes.
The average investment. When calculating average investment, let's say we don't have the salvage value, we only have initial capital, let's say 1 million. We still get the 1 million by 2.
Yeah, in case they don't have a disposal value, then we assume that it's 0. Therefore, it's just simply 1 million divided by 2, therefore.
Okay, thank you.
Yeah, in case it's not in mention from the examiner regarding, okay, what was the scrap value, because we assume it's 0. So simply it's 1 million, we divide by 2. Okay. I'm not sure we have done this question. This is November 2018. November 2018. 2018 question 1B. Have we done it? Have we done that question?
From my end, I can't see it. I don't think we have.
Okay, fair enough. Then go through it, discuss together. Okay, I suppose you've gone through it. So we asked here to get the payback, discount and payback period, and of course recommend which one the company should take. Okay, so you have alpha, we have and alpha and you have beta. Okay, so these are two projects. So we've been told that this cash flow given here, they're before tax. So therefore you need to reduce it by the tax amount you need to pay. The tax is 30%, and you'll be told the cost of alpha is 3.8, beta 8, zero salary value, working capital 825, cost of capital 12%, corporate tax 30%. Okay, and being therefore with project 1, pro alpha, sorry, this is pre-tax cash flow. Okay, so year 1, year 2, year 3, year 4. Okay, so have them in thousands. Okay, so pre-tax cash flow. Year 1 is equal to 2590, 2880, 3050, and you have 2950. When pay tax, of course, 30% of it. Okay, year 1, year 2, year 3, year 4. Yes, 777. 869, cut out 4. 915. 885. Net 2065. 2135. 2016. 1813. Okay, and that is it. No salvage value. Okay, that is it. The total initial capital, initial cost of the investment is first is the purchase cost. And the purchase cost for alpha, okay, you'll be told is equal to 3.8 million. Then you have working capital, which we need to invest towards working capital. The company need to invest, how much does it need to invest? They need to invest 825,000, so 0.825 million. Okay, and that is it. The 4.625 million is the initial investment cost. Okay, so since therefore you have here, we have the cash flow. We can have another column here. We'll call the cumulative cash flow. Cumulative cash flows. And here I should have included year 0. Okay, for year 0, this is what you've got here. 4625. So negative. Let me extend this a bit. Cumulative cash flow. Year 0, it's 40. Is the initial cost, which I just obtained there, 4625 negative. Okay, so that's for year 0. Year 1, we earn 1813. Therefore, the balance 46. We need to. This is discounted. Sorry, this is discounted payback period. So we need to discount the cash flows. Sorry for that. We need to discount these cash flows back to year 0 at the company cost of capital, at the project cost of capital, which is 12% as 505. So we need to discount them back to year 0 at the company cost of capital. Because this is discounted payback, so we need to discount the cash flows. We are discounting by 12%. So 0.8929, 0.7972, 0.7. 0.7118, 0.6355. So cash flow times present value times a factor, we give the present value. So I'll do to the nearest 1000, get 1619. 1607, 1520, 1312. Okay, look, this is discount payback period. Okay, I don't have space here to extend my working, so I'll just have here cash flow in present value. You'll have cumulative cash flow. Year 0, year 1, year 2, year 3, year 4. Okay, year 0 we got here negative 4625. These are the in thousands. Year 1 present value 1619, year 2 1607, year 3 1520, year 4 1312. The accumulated cash flow for year 0 4625. We earn 1619. Therefore the balance. Okay, so 46 negative 4625 plus 1619. Therefore the balance is 3 million and 6. We earn in year 2 1607. The balance is 1399. Then we earn 1520 next year. We have positive 121. Therefore, by the time the year 3 comes to an end, we have already been able to recoup the entire 4625. Therefore, the discount payback period for this project, therefore, by the end of it will be 2 years and it's a few months. Because before the year 3 comes to an end, you already have been able to recoup all your money. There were 2 years plus. You require, by the end of year 3, you require 13. You require 1399. 1399. This is going to be earned from year 3 cash flow. That we have to divide by 1520. This is going to give us 1399 divided by 1520 to give us 2 years, 2.92 years. That's for alpha. Okay, do the same for beta. Question? Okay, no question. That's for alpha. And the same we do for the beta. Okay, I'm not sure that's a good adding value by doing beta. But let's do it together. Beta, same process. Project beta will be equal to the cash flow for 300. So year 1, year 2, year 3, year 4, year 5, year 6. Okay, pre-tax cash flow. That is equal for 300. Equal to that's 290. Equal to that's 200. That's 700. 4850. And here 4420. This year 2, this year 3, this year 4, year 5, year 6. Then of course we pay tax 30%. Then to the cash flow for tax, therefore, after that 30%. There's cash outflow because you're paying, you have 90. Net amount is therefore 30,100. That's 10 cash flow. $987, $960, 1110, 1455, 1326. The cash flow net of tax 2303, 2240, 2590, 3395, 3094. Then of course we discount back to year zero, use the company cost of capital, 12%. Okay, so we go back to the tables, get the factors, and do that quickly. 8929, 8922, 18, 55, you have 56. Present value, cash flow is the factor, of course get the present value. $26.87. That's 6. $15.94. $16.46. $19.26. $15.67. Then here you can say that should have begun with year zero. Okay, so let me have here. Here, they began with year zero. So here I can do the initial cost for this investment. The initial investment cost. First is the purchase cost. The purchase cost for this investment. Data was to cost 8 million. Then cost working capital is equal to 825. Total is 8.825 million. That's the amount that we need to recover before the end of the life of this project, 8 million. If we in year zero, we have negative. Okay. We call this cumulative cash flow. We just call this cumulative cash flow. Okay, which is 8.825. Then year one, you recover 26. 8.25. Then you recover 26.87. The balance you need to recover is 61.38. Then you recover 18.6. Therefore, the amount you need to recover, therefore, okay, that's the 43.02. You recover another 15.94. Therefore, you require to recover 27.08. You recover another 16.46. Okay, which is 10.62. Then in year 5, you recover 19.26. Therefore, by the end of year 5, you have been able to recover the entire 8 million. Which means therefore the payback between year 4 and year 5. Therefore the payback for this project, the discounted payback for this project is 4 years. Okay. By the end of year 4, what you need is 10.6. Okay, 10.2 to be earned in year 5. The year 5 cash flow is 19.26. Therefore, the discounted payback period for this investment is 1096 divided by 1926 to give therefore 4.55 years with a discounted payback period for this project. Then you compare this discounted payback period for the, beta versus alpha. Alpha was 2.92 years. Definitely, of course, we take the one that has the shortest payback period. Okay, the company should invest in project alpha since it has a shorter payback period. It has a shorter discounted payback period, 2.92 years. 2.92, I guess, yes, 2.292 years. Question? Okay, no question. There is a question here you can do. Okay, we get NPV and get IRR. This is on May 2014. Question 1B. May 2014, question 1B. Okay, so check on yours up. Okay, there's a question that I've sent to you on May 2014, question 1B. Go through it, we discuss together. Okay, suppose you go through it. So you meant to get the NPV and you meant to get the IRR. And the company, that is going to sell this particular product at a price of 600 with a variable cost of 240. Fixed cost is 600 per annum. The company can claim allowances on a straight line basis because the capital is 10%. Okay, it's an easy one, so we can do it quickly. So first you get, therefore, what is the company tax depreciation? Okay, the company tax depreciation is equal to, it is on a straight basis. Per annum, therefore, will be equal to the cost of the assets, which is 1.56 million. We minus its disposal value, which is 1.5 million. We divide by its useful life, which is 5 years, and we get 900,000 to be the amount of allowance given per year. Therefore, the tax saving, because of the allowance, because of tax depreciation, therefore, again, we quote the allowance, which you have here, 900,000 we multiply by the tax rate, which is equal to 30%. They have the company tax saving because of the allowance given to it by the KRA, for example, is equal to 270,000 per year. This is therefore kind of tax saving, a cash inflow. Then it can be able next working can be on contribution and year 1, year 2, year 3, year 4, and year 5. In year 1, to the selling price, okay, contribution first per unit. The contribution per unit is selling price, which is equal to 600 minus variable cost, which is equal to 40, to get a contribution per unit equal to 360. Therefore, in year 1, the total contribution is contribution per unit multiplied by the number of units, 8,000. Year 2, number of units, 8,000 times 360. Year 3, number of units, 7,000 times 360. Year 4, 5,000 times 360. Year 5, 3,000 times 360. Okay, those are kind of for what will be the total contribution received over the life of the investment. Okay, and that will give us year 1, 2,880,000. Okay, year 2, 2520. The same applies to year 3, 2520. Okay, here 1.8 million and 1080. Okay, that gives us for what to be the contribution to be earned over the life of this investment. Yeah, and that is it. Okay, solution. So year 1, year 2, year 3, year 4, year 5 contribution. You've done above there already. Year 1, 2880. So we'll have them in thousands. 2880, 2520, 1800, and 1080. Because you pay tax. This fixed cost, sorry, there's a fixed cost. Before you pay tax, we need to less the fixed cost. So less fixed cost. Which in every year it's 600,000. So we subtract 600,000. Year 1, 2280. We have 1920, 1920, 1400, no 1200, and we have 480. Then you pay tax, and that percent. Therefore, year 1, the tax you pay 684. Year 2, 576. Year 3, 360. Year 4, 144. However, we have tax savings, okay, equal to 270 per year. Therefore, tax saving 270 cash inflow, 270,000 per year. Is there working capital? There's no working capital, and that's kind of the cash flow. Year 1, year 2, year 3, year 4, year 5. For the first year, we get 1866. Second year, 1614. Fourth year, 1110, and fifth year, 606. We want to get NPV, so it's count all the cash flows back to year 0, and the company cost of capital, which as per note 10, but as per note 4, is 10%. Okay. Go back to the table, we discount cash flows at 10%, 0.991, 0.8264, 0.7513, 0.683, and 0.6209. So the cash flow times the factor, give the present value. Year 1, 1694. $13.34, $12.13, $75. I hope you're confirming my workings. I'm not sure where they're correct. 376. Therefore, to get NPV is therefore the sum of present value cash flow minus the initial cost. The sum is equal to that 5375 minus the initial cost. The initial cost of this investment, I think, was 80 million. I don't know. I lost track of the question. There was a scrap value, which I think I forgot it. Okay. Scrap value, we need to add scrap value because there was a scrap value which was meant to be earned in year 4, in year 5. Because by the end of the life of this investment, we need to be told that you can be able to earn some money from the sale of this instrument. So I have to look for someone to adjust. So here, let me add here scrap value, which will be received in year 5, which is equal to 1.5. Okay, so let me add manually. $21.06. A discount back to year 0. Get 13.08. Therefore, NPV. Sum therefore will have to be different because of that adjustment you just made. Cash flow 1694 plus 1334, 1213, 758, 1308. 7, confirm those figures. We minus 6 million, we get a positive 307,000. Confirm.
Yeah, that's correct.
This is for the NPV. Okay, next we need to get IRR. And IRR says given us A plus B minus A, NPV at A, NPV at A minus NPV at B. A where A is the lower discount rate and B is the higher discount rate. Okay, we are done A, assume that it is 10%, so we are done with A. So we need to do B. Okay, the use of trial and error method. So what if we discount these cash flows to, let's say, this was at 10%, okay? What if we discount at, let's say, 12%, okay? Just sort of figure out, just pick it. Okay, you can try 13, 14, 15, but let me try 12%, okay? So 12%, the NPV will be equal to, you have year 1, year 2, year 3, year 4, year 5. These are cash flows. We're going to show how you got the NPV, okay? Therefore, cash flow for year 1, we got 18. So here they are. So we simply replicate them. So 1866. Year 2, 1614. Year 3, 16, 14. Year 4, 11, 10. Year 5, 2106. Then cost will come back to a 0. This time around 12%. These are trial. Don't forget, I said you can use any other rate that you prefer to use. But of course, what you want to do, you have to be careful. The two rates need to be as close as possible. Get together. Okay, don't use 10 and then next one to be 20%. No, you get end up with having mistakes there. An error of estimation. Okay, 0.7972, 0.718, 0.6355, 0.5674. And just multiply, get the present value. It is 6.8929. Get 1663. $12.87. 1149. 705. 1195. Therefore, NPV, sum of present value cash flow. So you do from the first year. Which is equal to my calculation, I got that. 6 million. We get negative 1,000. Let's confirm that.
Correct.
Therefore, we can say therefore the IRR is between 10 and 12%. Okay. Therefore, the IRR therefore will be equal to 10% plus the difference between the two rates, which is 2%. Value 10%, we got 307. 307 minus 1,000. I get how much? 11.9. We get 11.99 or 9 what?
Yes, 99.
Okay, 11.99%. Because of the IRR. Okay, of course, don't forget you divide the company. So first, based on NPV, we got a positive 307. Therefore, the company, don't forget you write it down. You advise the company. Okay, the company should invest in the project. Should invest in the project. Since the NPV is equal to 307 positive, 307,000. Based on IRR, the company should invest in the project. Invest in the project. Since IRR 11.99% is greater than cost capital. Is greater than the cost of capital. 10%. Okay, that's what you're meant to do in that particular question. The use of NPV, the use of the IRR. Any questions so far? No, there'll be a question by the way in the exam. So I suppose that you will be able to do the question if the examiner does present it to you.
I have a question.
Yes, ask.
When we are given the working capital,
Yes.
is it always that we recover it in the final year, or if they don't tell us, we don't?
So generally, what will happen regarding the working capital is that in year 0 is a cash outflow. In the final year is a cash inflow. Okay. So that will be the case here. Okay. So in case the examiner is silent, then of course you assume that it will be recovered. Okay. So in case the examiner is silent regarding working capital, you assume it will be recovered in the final year. Therefore, it's a cash inflow in the final year.
Oh, okay, thank you.
Yes. Okay. Now, for the sake of time, now I don't know what I think. Maybe the next area, which I think is crucial and might be also there in the exam, is on cost of capital. Okay, so I know there's a few more questions we could have done regarding the NPV, IRR. Okay, but I suppose that maybe the next bit you can do is on cost of capital, because it's supposed to be there in the exam. So, yes, maybe we can do one question on cost of capital. Unless there's another area where you think that it's banned, so let's first do that cost of capital. And in case you have any other question, then we can attempt to answer it in the few minutes remaining. So then we can get a good question on cost of capital. And if you have one, then you can suggest for sure. This is one here. I really hope you have not done it. So there's one here which I think that could be a good question. November 2016, question 2B. Have we done it? This is on cost of capital. This is on cost of capital. Have we done it? Or rather, we can do the one on the mock. Yes, I think that would be better. So there's a question in the mock. So I hope all of you, of course, definitely all of you have the mock paper. There's a question there, which I think we can do. Let's do that with the one on the mock. Okay. So it's question 5B. Question 5B. Okay, question 5B on the mock paper. Can someone share the mock just in case someone doesn't have the mock? I don't know whether all of you have that mock paper. I'm trying to see it. I can't see it on my phone here. Someone can reshare that mock paper just in case someone doesn't have it. Thank you, Robert. Okay, so go through that question, then we attempt to do it together. Okay, I suppose that you have gone through the question, so let's attempt to do it together. So you've been required to get the company cost of capital, okay, on market value basis. So of course the first step definitely is to determine where the capital came from. Okay, if you go through the profit, you go through the balance sheet of the company, there's equity capital, there is long-term borrowings. So therefore, we may want to determine. So money came from equity. They also came from preference share based on the additional information below the balance sheet. Also came from a bank loan, as well as they came from a bond. So therefore, we have 4 capital sources. Okay. Next, we get the cost of capital from each one of them. So let's begin the cost of equity. So don't forget to say you can use 2 models. You can use the capital as a prices model, or you can use the dividend growth model. Okay. So based on the information given here, we are going to be using the dividend growth model because we'll be given the dividends. The cost of equity is equal to D naught 1 plus G, P naught, okay, plus G. D naught is the most recent paid dividend. If we told the share price of the company is cum dividend, therefore, we're going for D naught will be equal to the cum dividend share price 7.52 minus the ex dividend share price, which is 7.07. Therefore, a dividend equal to 0.45. You've been given the dividend for the last 4 years. Therefore, we can get the growth in the dividend. We got D 2017 divided by D 2013. Okay, how many years of growth? 4 years of growth. The power of a quarter minus 1. Therefore, 0.45, which is we have just obtained here. We divide by 0.37, okay, to the power of a quarter minus 1. What's the G? 'What do you get with the growth in the dividend?
$5.02.
5.02%. Okay. Therefore, can I get the cost of the equity? It will be D naught 0.45, growth 1.052, divided by P naught, which is the market value 7.07, plus the growth, the G here, 0.052. As percent, what do you get therefore? The cost of equity for this company.
$11.72.
11.72. Yeah, sure about that, because I doubt it. I'm not sure I doubt it, but anyway, is it correct? 11.72.
Yes.
Oh, okay, fair enough. Okay. 11% to become for the cost of equity. Next, we get the next capital source is preference share. Then we get the cost of preference share. Okay, is equal to P equal to the preferred dividend divided by market value of the preference share. Of course, we express as a percent. The preferred dividend, okay, for this preference share is equal to is paying dividend at what rate? at 5%. 5% times its nominal value, which is equal to 0.5 to give us 2.5 cents. Therefore, the cost of preference share will be the dividend, 2.5 cents, divided by the market value of this preference share, which is at 1 cent, and we express as a percent. To give us how much? 8 point.
8.33.
8.33% for the cost of preference share. Next, the next capital source is the bank loan, the cost of bank loan. And to the cost of this bank loan, it is a variable interest rate loan. Therefore, we need first to get the cost of the bond because this is a variable interest loan. Okay, therefore we're going to be using the cost of the bond as the cost of the bank loan. So the cost of bond. So this bond is paying. So the interest is paid. It is paying an interest at a rate of 7% per annum, 7% of its nominal value. Do you pay tax? Yes, 30 tax. Do you pay tax here? Yes, 30%. Therefore, minus the tax rate to give therefore the net amount we received per year of 4.9 because that percent goes to tax. The redemption value, okay, is 5% premium, P naught. The redemption value, sorry. The redemption value of this bond, which will be redeemed in year 4, is 5% premium to the nominal value. 105% times the nominal value of 100, we get therefore 105. The current market value of the bond is 102.34. Yeah, that is it. I think we can now be able to get it. So don't forget, if you have to discount the cost of the bond, if we discount the cash flows, the redemption value, and the interest at the common cost of debt, then we ought to get a 0. 0 be equal to negative P naught plus the market value of the interest we received, the present value factor, okay, N years R%, where R% here is the cost of the bond, plus redemption value, discount back to a 0, okay, N years R%. To put it into context, 0 ought to be equal to negative market value, 102.34. The interest we're earning will be 4.9 times present value factor, 4 years, R%. Redemption value is 105 times present value interest factor, 4 years, R%. So as we say, don't forget to use trial and error method. Is a trial and error method. So what if we discount these cash flows at, so first thing to note that what if this bond was to be irredeemable? Okay, if this bond was to be irredeemable, its debt would be equal to the interest 4.9 divided by the market value 102.34, and of course we express this as a percent. So if this bond was to be irredeemable, what would be its cost of debt? It would be equal to 4. 79. So in case this bond was to be irredeemable, its cost will be equal to 4.79. The reason why I want to do this working is just to know that the cost of this bond will not be too far from the 4.79. But you don't need to do this. You don't need to show this in your workings, in your calculations, in your final answers. But as part, it can be part of your rough work, more or less. Okay. But you mean therefore the cost of this bond will not be too far from the 4.79 here. So what if therefore begin at 5%? So therefore let's discount these cash flows. Okay, we use arrow 5%. Therefore, if we are to use 5% at 5%, you'll be getting negative 102.34 plus 4.9 times present value into factor, 4 years, 5%, plus redemption value is 105 times present value into factor, 4 years, 5%. What do you get? What do you get? One 1.42 positive. Confirm.
Yeah, it's correct.
Great. Okay. So what if now it comes the same cash flows, but not at 4%? Okay, will be equal to negative 104.34 plus 4.9 times present variant factor, 4 years, 4% plus 105 times present variance factor, 4 years, 4%. How much do you get? I think we should have increased the rate, not decrease it. Yes, let's increase the rate because this was a positive. We need to increase it. Let's increase it to 6%. Sorry. Let's increase to 6%. So here, this is 6%. This is 6%. I'm getting negative 2.19. Confirm.
Yeah, correct.
Therefore, the cost of the rate, therefore, will be equal to 5% plus the difference between the two rates, 1%. The value 5%, 1.42. 1.42 minus 2.19. You get 5 points. $5.39.
Yes.
The cost of the bond, therefore, is equal to 5.39. Don't forget here we use the IRR formula. I will still remember it. So since the bond here, we know that it's since the loan here, we know that it has a variable interest rate, which is not given to us. What do? We assume that its cost is the same as the cost of the bond. Okay, and assumption we make. So the bank loan cost is also equal to 5.39. That's an assumption that we made because this loan you have here is a variable interest rate, which you don't have. Therefore, what other debt instrument does this company has? It has this bond. What's its cost? 5.39. Therefore, we assume they have the same cost. Next, we need to get the market weights, the market values. So we have equity, we have preference share, we have bond, and you have the bank loan. Okay, we need to get the market value for each one of them. The market value of equity is the market value per share, 7.07, times the number of shares the company has issued. The number of shares this company has issued is equal to, I've lost track of the question. Okay. the number of shares this company has issued. The total nominal value of company shares is 12 million. The nominal value per share of this company is equal to 0.5. Okay, that gives the number of shares of this company. Preference share has a market value of 0.31. Nominal value of preference share of the company is 5 million. The nominal value per preference share of this company is equal to also 0.5. Let's get for 3.1 million. The bond has a market value of 102.34 per bond. The nominal value of the company, the total nominal value of this bond is 10 million. The nominal value per bond is 100. You get therefore 10.234 million. Bank loan doesn't have a market value, so therefore uses book value, which is equal to 3 million. Market value of company equity shares, therefore how much? That's 9.68. $186,0114. Confirm.
Yeah, correct.
Great. For the total market value from the company, different finance sources. Therefore, company with average cost of capital, market value of equity, 169.68 million, times the cost of equity, which we got 11.72. Okay, yes, 11.72. Here it here. Therefore, times 11.72. Market value of preference share, 3.1 million. Cost of preference share, we got 8 point something. We got 8.33 times 8.33% plus the market value of bonds, 10.234 million times the cost of bonds, which we got 5.39% plus cost of weight of equity, weight of bank loan, 3 million. And we multiply by its cost, 5.39%. We divide by this, the entire market weight, 186.014 million. And you get how much?
Excuse me, sir.
Yes.
Please, can you scroll back up? I think I have a question on the cost of equity.
Cost of equity.
Yeah.
Here you go.
I thought
Yes.
In the formula,
Yes.
the dividend we use is the most recently paid, and I think we had said that if it has not yet been paid, there's I'm not 100% sure, but I think there's a difference in how you'll calculate it.
Okay. Don't forget the reason why we have assumed this 0.45 is yet to be paid, isn't it?
Yes.
However, the market price of this equity share is cum dividend. Have you seen that? The 7.52 is cum dividend, isn't it?
Yes.
Well, what that tells you is that the company will be paying the dividend in the very near future, in the next few days, for example. It implies, therefore, that dividend the company will be paying is like it's already in present value term because it's getting paid in the next few days.
Okay. So when do we use the other method when it's not clearly stated how much they'll pay?
No, it's the same method. There's no other method. It's the same method. The only difference here, what we doing is that
Yeah.
the D note is always the most recently paid dividend, except in the case where the company's share price are trading come dividend. Now, the share price are trading come dividend, that dividend the company will be paying in the near future, in the next maybe few days, it becomes therefore a D note. This is become for a D note. This is become for our D note. If the share price, if this 0.45 was paid in the 2 months' time, the share price most likely will not become dividend, it will be X dividend. Therefore, this becomes for our D1, if that's the case. But since the share price is come dividend, it means if we pay in the next few days, then this comes therefore our D note, not T1. Is that clear?
Yes.
Conventionally, D note is the most recently paid dividend. That's always the case. However, if the share price is traded come dividend, what does it mean? It means the company will be paying dividend in the next few days. Now that dividend the company will be paying becomes therefore D note. Is that clear?
Yes.
Okay, great. Yeah, okay. So that's it can be a bit confusing for sure. Okay, but this don't forget this. If once you see the company share price trading come dividend, then that dividend will be paid in the next few days is D not D1. Is that clear? That's clear, I hope.
Yes, but sorry. If it's D1,
yes.
If because in my book here in the notes I had written D1 is equals to D naught into brackets 1 plus G.
Yes, D1 is equal to D naught 1 plus G. Yes, it is.
Mm-hmm. So what I'm wondering is that is there an occasion where we'll only have D1?
Yes, you can have it. If the company paying
and not the other one, so we'll remove this other part of the equation. We'll only do D1 over the market price plus the growth.
You can have cases where the company, we have been told that the company in 9 months' time will be paying dividend. If the company in 9 months' time will pay dividend, don't forget the same year, okay, in the next 9 months, then that dividend is D1, not D naught. Then you can have a case where the P naught, the cost of equity, will be D1 divided by P naught plus G. So if that's the case, therefore, that's the dividend to pay in 9 months' time becomes therefore a D1. Yes. They can have such cases.
Thanks, I've understood.
Okay, great. Therefore, what's the company's cost of capital on weighted average basis? 10 points. You just feed this in the calculator and get an answer. 10 points. Okay, from my calculation, I got 11.21%. And that's what therefore we get it for the cost of capital to the company. Any other question? Okay, you can now proceed any further. But that is it. Okay, so those are some of the topics that you need to be more careful with. Okay, cost of capital, in event appraisal of investment, mostly towards the NPV IRR. Okay, as well as on working capital management. So those ones for sure, they'll be there in the main exam. So I suppose that do enough revision on those questions. Okay, I don't think there's any other class we're going to do on revision. I don't know, but I guess that is it. Okay, I don't know. In case next week we meet, I have no idea. So, so that is it. Okay. So I wish you all the best. I wish you all the best in your main exam. Okay. So here any question, don't forget you can use the group, and I'll attempt to answer some of those questions. Okay. So use that group also for your revision. In case any question that you have, ask your fellow students. Okay. I'll also be there, so I'll also attempt to answer some of your questions. Any question?
Hello, is it possible to get the solutions for the mock?
Yeah, now for these ones, like this one, this is a mock, so I'm not giving a solution because this is a mock question you've done. So I'm not giving a solution to it because you've done it together. But those are the questions that we have done together. I'll provide them for sure.
Okay.
But the one you've done together, I'll not do that for sure. So you have the question, you have the solution with you like now already.
Okay.
Okay, great. Okay, fair enough. If there's no other question, and don't forget to sign. All the best in your exam.